It's October. The deferral periods for many have come to an end. Now what? How big a problem is it and what can you do? Ted and I have many thoughts, and it all starts right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
As of August 31st, 778,000 Canadians who were customers at CBA member banks, so I'm talking about the big banks here, deferred or skipped a payment on their mortgage. 16% of the number of mortgages in banks' portfolios. Pretty big number. The big six banks hold roughly 72% of mortgages, so when you include credit unions and other mortgage lenders, that's around 1 million mortgages where payments were deferred. The average monthly mortgage payment in Canada, again, according to the Canadian Bankers Association, is around $1,333 a month. So you do the math, that's over $1 billion in mortgage payments deferred each month. But there's more. It's not just mortgages. Mortgages accounted for just 27% of the accounts deferred in May 2020, which is the most recent stats I've got. Credit cards were another 32%. Auto loans, 10%, 12% were installment loans, 13% were open accounts like cell phones and things like that. So a lot of deferrals. Ted, welcome back. We're going to talk deferrals today.
Right. Picked a lovely topic.
Now, you and I understand why people ask for deferrals.
Sure. If you can't make your payment, defer it.
Well, and I'm not working. I've been laid off because of coronavirus or whatever else. Right. And the bank said, hey, we'll let you defer. Okay, so I'm going to defer. And my guess is in most cases, the people who've deferred are people in exactly that situation.
Right.
I lost my job. I've been laid off. Now, I'm sure there were some people who said, oh, well, if they're going to give me a deferral anyways, I might as well take it because maybe I'll lose my job in a couple of months. Why not build up some cash?
Right.
Regardless, that's not what we're here to discuss. What I would like to start with is what are the implications? So we all understand what a deferral means. It means I don't make my payment this month.
Right.
So I will have to do something in the future.
At some point, you've got to make that payment. Plus, you've got to make the accumulated extra interest on not making that payment.
And that's the kicker right there.
Right.
It's the interest that is the kicker. So if I'm the big bank and you have a mortgage with me,
okay,
and we agree I'm going to let you defer 3 months worth of payments, 6 months worth of payments or whatever. And we are recording this. Do you have any idea what the date is today? October something?
Right.
We're in the middle of October. I don't know where.
Pre-Halloween.
It's yes, it's 3 days after Thanksgiving. It's Wednesday is when we're recording this. And so the banks allowed people to defer up to 6 months worth of mortgage payments.
That's right.
Which ended around the end of September.
Mm-hmm.
And so here we are into October, and this is all.
It's time to start paying.
It's all starting to hit. So the banks could do a couple of different things. They could say, okay, whatever you didn't pay, we're going to tack it on to the end.
Right.
Or they could say, let's recalculate your monthly payment so that you're paying it all off between now and the end of whatever your term was.
Right.
What's the problem with that? What's the implication of that? What am I going to see if I am a human being who has a mortgage?
Well, so first, if the bank tacks it on to the end, that means you're going to be paying interest on that extra interest until the end of the mortgage. So they're basically, it's a money grab. I mean, you needed the help, but they found a way to make more money at it. If they recalculate your mortgage payment so that it still ends at the same time, that means now you have a bigger payment to make. And so if your budget is as tight as most Canadians are, you're living paycheck to paycheck, suddenly having to pay an extra $100 or $200 a month to catch up those deferred payments is going to be a burden on you.
Yeah, and we're not going to do the math here because everyone's mortgage payment is different, but
Right.
It could easily be an extra $50 or $100 or $200 or whatever on your mortgage payment. And a lot will depend on how much longer there is on your mortgage.
Right.
How many more months is there to squeeze it all in? So 6 months after I start the deferral, my mortgage balance is higher.
Correct. So there's been no payments for 6 months. So at the very least, you'd expect it would be identical to what it was when it started. But you've got 6 months of accumulated interest. So you didn't pay down the debt at all. Plus, you actually now have interest on the interest for the money that you didn't pay.
So you have a higher mortgage balance, which now has to be paid. Okay, so that's the implication of deferring. And again, you hit the nail on the head. I didn't have any choice. I didn't have a job. I wasn't going to be able to make my mortgage payments.
Yeah. I mean, one of the frustrations of something like a pandemic is you didn't do anything wrong, and yet you're still being penalized for it.
And you have to pay. So that's mortgages.
Right.
Let's talk about credit cards because, as I said, 27% of all the accounts that were deferred were mortgages, but 32% were credit cards. Now, that's kind of silly statistic because the balance owing on a mortgage is probably higher than the balance owing on a credit card.
Yeah, but the effect on the credit card is more dramatic. So the mortgage is at 3%, the credit card is at 20%. And so you defer a payment on a credit card, you're paying interest at 20% on that money that you haven't paid. Now you're paying 20% on the interest that you didn't pay.
So if I had a $10,000 credit card balance and I deferred it for an entire year, that's 20% of 10,000, that's $2,000.
Except it's also interest on the interest every month on that $2,000. So it's more like $2,600.
And so if I deferred it for 6 months, well, okay, maybe it's $1,300, but still my credit card balance has gone from 10,000 to 13,
right,
or 10,000 to 11,000 or 12,000 or whatever.
So if you were having problems before this started because you really shouldn't be carrying a $10,000 credit card, the deferral period's over, now you're carrying an $11,000 credit card.
And you combine that with the fact that I wasn't working for a few months, so I actually drew on my credit card.
Right, which is what most people have done.
So my credit card balance is higher for two reasons. I've drawn on it and because of the accumulated interest.
Yep.
So now there are some banks who did give partial credit and made special arrangements, but the point is your balances are going to be higher now than they were at the start.
Correct.
Okay, now you're the car guy. Mm-hmm. So I want to talk about car loans, and what we'll do for those who are watching on YouTube is we'll put up on the screen an example of what a deferral agreement looked like.
Right.
So, and this one happens to come from Scotiabank because that's the one we pulled out. So let's walk through this here because this is clause 5 of their agreement.
Yeah, and this is confusing stuff.
So see if you can make sense of it then. So during the deferral period, each deferred loan payment will be added to your outstanding loan account balance as of its due date.
Right. So that means your loan balance today was $10,000. Your payment was supposed to be $300. Your loan balance is now going to be $10,300.
Okay, makes sense. That's what we've been talking about
right
all along. Okay, so continue on with how it works then. So this will result in an increase in the outstanding balance. Okay, you just said that.
Right.
At the end of your deferral period, you must resume making regular loan payments as they become due. So
you deferred for 6 months. Unless something changes, month 7, they expect you to start making your regular payments again. But it doesn't stop there because what Scotia's done in their example is they say they want you to also catch up all the interest that hasn't been paid for those 6 months. So they want you to make an extra payment when you start up your payments again.
Okay, that sounds like a problem to me. So if I've got a $10,000 car loan, and I don't know what's the interest rate on a car loan, let's
call it 10%
because then we can do the math. Okay, so that's $1,000 a year. That's $500 for 6 months.
Right.
So I've got this $500 extra liability that's potentially tacked on at the end.
Yeah.
Your first loan payment after your deferral period will be adjusted to reflect the additional interest accrued and will be higher in order to maintain your extended term. So this is the extend and pretend thing, right?
Right.
So your term, I originally had a 5-year car loan. Now I've got a 5.5 year car loan.
Right.
And my interest, so if I've got an extra 5 months tacked on, not only am I paying for an extra 5 months, but my monthly payment is also higher.
Only the first one, though. So what they're saying is whatever interest is accrued during that 6-month period, you're going to pay it with your first deferred loan payment. So your regular payments stay the same after that.
But that's a huge hit.
Well, certainly. It's going to be more than your regular payment. I'm willing to bet that for almost 90% of the people.
Yeah, obviously, depending on the size of the loan and the interest rate, but there aren't a whole lot of very low interest rate car loans with a bank.
Right.
Perhaps with the original dealer. Your first loan, so your first loan payment after your deferral period will be adjusted to reflect the additional interest accrued and will be higher in order to maintain your extended term.
Yeah, so the example we were using, that $10,000 loan, you've accumulated $500 of additional interest. If your payment is $300 a month, your first payment back is going to be $800. All the interest plus your regular payment.
Gotcha. $500 in interest plus the $300 payment.
Right.
So I've been out of work for a while. Maybe I'm back now. I certainly don't have a whole lot of cash. Probably. That's why I was deferring to begin with. And now I'm hit with this big payment.
Well, and the people that are deferred on the cars have probably deferred on their mortgages, have definitely deferred on their credit cards. So you do the math, and it's just a nightmare.
It's a massive thing.
Yep.
You will receive a notice from Scotiabank within 30 days of your deferral, setting out the updated cost of borrowing information for your loan. So anybody in this situation should already know what those numbers are.
Sure. Somewhere back in March, they got a letter saying, okay, this is what you're going to have to pay as the extra payment. And if they were careful, they've been trying to set that aside. if you've been on CERB or EI or just no money coming in at all, how could you do that?
Yeah, it's just impossible. So, okay, so we're going to get to the practical advice section on this in a minute, but since you're pretty calm already, let's go to your favorite topic. And fortunately, I've got the protective plexiglass screen in between.
It's not very thick.
No, it's probably not going to withstand a huge blow, but 12% of loans deferred were installment loans.
Yeah.
So no doubt there were tens of millions of payday loans and installment loans deferred. So you got any thoughts on that?
Well, payday loans are at the absolute worst end of the interest spectrum. The installment loans that those companies offer are normally anywhere from 40 to 50%. So if what we said about mortgages and car loans and credit cards was bad, just multiply it. It's exponential.
Infinitely worse.
Yep.
Yeah, the interest rate is that much higher. So what are you seeing out there? So you and I talk to people on the phone all the time. I mean, we're not meeting clients in person much. We're doing it entirely over phone and video and everything. But what are you seeing?
Well, interestingly, the phone traffic has picked up recently because the deferrals are ending and people are afraid. They just don't know what to do. They're still on, well, it's not even CERB anymore. They're on some kind of modified EI, and they are hoping for the best, but all of these things that they delayed for 6 months are now coming due.
Yeah, and that's why I wanted to do this podcast at this time, because we've finished the deferral period, and you're right, CERB ended, and we talked about this on last week's show with David McDonald. CERB ended, and so we've now got CRB, which is sort of combined with EI, sort of.
It's a new condensed CERB. You drop the E.
That's right. So it's more efficient. And of course, if you watch the comments on Reddit and Twitter and everything this week, a lot of people are having trouble getting logged in and getting the stuff done.
Well, more efficient means less money, right?
Yes, exactly. So it is still a base of $500 a week, but now because it's kind of quasi through the EI system, they are taking off tax. So you're only going to get $400 a week, which in the long run is good because next year when you file your taxes, there will already be something set aside. This was you and I's big worry.
Our complaint with CERB.
Yeah. And again, we understood why it was done that way.
Yep.
But if you got CERB for 3 or 4 or 5 or 6 months, then you have potentially a pretty big tax liability coming up. So you got all these forces going on. You've got the CERB has ended and it's been modified to this new thing, which for some people will mean they're getting less money.
Right.
The economy is not fully open by any stretch of the imagination.
Exactly.
Case counts have gone up here in Ontario since the beginning of October. And you've got the deferral periods ending, which of course means, oh, great, I've got less money coming in, but now I've got these new obligations. And then the other thing I'm seeing is we now are in the second wave of layoffs.
Right.
So there were a lot of companies who at the start of this said, okay, we don't know how long this is going to last, but the government has this wage subsidy.
Yep.
So no problem. We'll keep our employees on. The government's covering 75% of their wages. So even though our work is down, no problem. We'll keep them on. Well, CEQs, as we call it, CEWS, emergency wage subsidy. You've got acronyms for everything.
We do.
It didn't end at the end of September, but starting in October, the amounts that you can draw on are reduced. You're not getting a full 75%. Again, the rules are very complicated. We're not going to get into them here. But that has led a lot of businesses to say, well, okay, you know what? We can't afford to be continuing the way we're doing. We're going to start laying off people. We're certainly not bringing any extra people back.
Yep.
And I understand that the employment rate has actually increased over the last few months, but that's because it was at such a very low number to begin with.
Right.
So I'm hearing from like hotel operators, or people who work at hotels, certainly in Toronto. Some hotels completely closed down. Some were operating at like 5% occupancy. In August, some of them got up to 30%, even as high as 40%, because people were going, well, you know what, I can't travel outside the country. Why don't I go into Toronto, staycation, whatever?
We'll try it.
Well, when I talked to them over the last week or two, we're back down to 5% again.
Right.
There's no business travel. There's certainly no vacation travel.
Yep.
So now it's like, well, I was brought back to work because volume picked up a little bit, but now it's gone back down. So you factor all that in, it's no wonder that people are under massive stress. And I assume you're seeing the same thing.
Oh, and the thing that's adding to that is that Revenue Canada has now figured out how to work. And so some of their agents are back on the collection trail. And so all of these people that you haven't had to worry about any of this other stuff. On top of that now, if you're 60% of the people that we talk to, the government's going to start looking for their money again.
Yeah, and CRA will take a long time to get back to full operations, but they are gradually starting. Now, the other thing I've noticed is that the collection agents are still, I'm not seeing them operating at full capacity yet.
They're not.
And certainly we're not seeing the same level of court activity. But what I am seeing is collection agencies going after very old debt.
Yes.
So it's like, okay, we're not really sure what's happened over the last year or two, but we've got all this debt that we bought or that we've been hired to collect from 3, 4, 5 years ago. And maybe we were in a position to get a judgment. Maybe we already did. I actually saw one in the past couple of weeks who did go to court.
Oh, really?
So this is in September.
Yep.
Managed to get a judgment against this person. Actually, I don't think they've actually been to court, but they certainly issued the statement of claim.
Yep.
So there is a court number. And so that particular person called me up and said, well, I guess I better do the proposal now because...
Right. And the collection agent doesn't care if they actually get to court or not because the fear tactic is what they're working on. Now it looks like, yes, court is possible. I got to do something.
Right. When the courts were closed, that wasn't a particularly good fear tactic.
Right.
Although most people didn't understand that. So if you've been continuing to work throughout this period and we're just hanging on and now the collections have started again, it's like the final whammy to it. So, okay, that's the background. Very stressful out there, I think is the bottom line. And I think we all figured, well, if this is going to last for a couple of months, I can endure.
Right.
But now it's been 6 months and it's probably going to be a year and I'm going to be working from home and I'm going to be underemployed. And it's like, okay, I'm just really, really stressed out about it. So let's go to practical advice. You've deferred payments. Now you have to start paying again. So I have 7 things on my list here.
Yep.
And there's probably more. So let's start with the basic ones. Figure out what you can afford and can't afford based on your budget. So what's your recommendation there?
So most people are reluctant to do this, but you've got to take a look at your finances. How much money is actually coming in right now, and therefore, how much can you spend? And if you're spending more than you've got coming in, you've got to find ways to cut back. Otherwise, you're going to be falling on credit.
So let's go through that analysis then. I'm just going to skip our points here because we'll just wing it here. So I do that. I look at my budget and I go, well, I'm on the new CRB. I'm getting EI. I'm getting whatever income I've got. I've got to pay my rent.
Yep.
I got to buy groceries. So if there is no room in my budget at all to service debt, let's start with that scenario. Right. Okay, so what's your advice then?
Well, realize that if you can't service the debt, you're not going to service the debt. And try not to let that lose focus on everything else. If you are banking with the same institution that you owe the money to, open a new bank account. Get out of town. Go. So if you're banking with Big Bank A, switch to Big Bank B if you don't have any debts with them, because there's something in the Bank Act called the right of set-off. If you don't make a payment on your debt, the bank's allowed to take it out of your bank account. Well, if you don't owe the bank you're dealing with any money, they're not going to do that.
Yeah, the legal concept is if there's $20 sitting on the table, they can pick it up.
Right.
That's the legal concept. So let's take that scenario then where I have income that is entirely from the government, EI, CRB, something like that. Can that be garnished by my credit card company?
It's very difficult to garnish unemployment insurance or the CRB. It can be done, but a court is not likely to do it. If you're living on pensions or any kind of fixed incomes, it can't be done at all.
So you are what we call creditor proof. That's kind of like being bulletproof.
Right. And so you shouldn't let a collector intimidate you or scare you into finding some way to make a payment.
So if you had $2,000 a month coming in from EI or a government pension, something like that, and that was enough to cover your rent and groceries, but that's it, your advice would be open a new bank account at a brand new bank so that the people you owe money to can't just do their pre-authorized payments and take money out, and then do nothing?
Probably. I mean, it's do nothing sounds like you're ignoring the problem, and that's not what this is. You're making a decision to say, I can't make these payments. I know I'm not going to make these payments. So now you need to start looking at, okay, well, what's the alternative? So until you've got income coming in again, maybe there's no alternative and you're just going to have to put up with not making the payments. If the stress is getting you, you contact somebody like us and we'll give you what your options are legally to get out of debt.
Yeah, and the two obvious legal options would be a consumer proposal or a bankruptcy, but a bankruptcy costs money.
Yep.
You're going to lose potential tax refunds, and there is a cost to the bankruptcy. The biggest cost being if you go back to work, the payment in the bankruptcy goes up. So I had, I think, 3 conversations with people yesterday who are currently not working, hoping to get back to work very soon. And these are people who have decent jobs.
Right.
And so my advice to them was, well, you could do a bankruptcy today, but the amount you pay changes every month.
Depending on whether or not you're working and how much you're making.
Exactly. So every month that you're bankrupt, you have to report to us what your income is. So the first couple of months of the bankruptcy, well, maybe the cost of the bankruptcy is really low, but it could jack up from there. Yeah. It's a difficult decision, though, because if I start the bankruptcy now, maybe the cost is going to be less. Right. But then if I end up going back to work and it ends up being a whole lot more, was that the correct decision?
Well, we've been telling people since the beginning of this back in March, defer the decision to file bankruptcy, simply because rent, food, medication, these things are your priorities. If you're scrounging to find some way to pay a legal fee, it just doesn't make sense. And a lot of our competitors think we're nuts, but the right answer right now is look after yourself. Yeah, and you're right. We're outliers on this. And obviously, we are talking ourselves out of business because if we say to someone... Not literally, folks. We're okay. Well, yeah, I mean, out of that particular person. So someone calls us and says, well, I think I need to go bankrupt because I got all this debt. And we say, well, they can't garnish your wages. Yeah. They can't really sue you. I mean, maybe they could, but it's going to take a long time. So they end up not filing bankruptcy. Well, obviously, we don't get paid if somebody doesn't do anything. And our answer is don't do it yet. Right. So when you get into a stable situation, you're back at work or you figured out what your month to month is actually going to be, then we'll look at dealing with these things that are causing you extra stress. Yeah. A typical bankruptcy is going to cost $200 a month for 9 months, assuming you don't have any assets, your income is low, you've never been bankrupt before, nobody objects, and so on. Right. So if you have an extra $200 kicking around, fine, do the bankruptcy. But in a lot of cases, it's like, well, no, I've got to pay rent and buy groceries. That's more important. And that's why we're saying to defer. If you're living on CRB, you don't have an extra $200 a month. Right. So that's why we're telling you to wait until your situation changes. And yes, we understand that perhaps the bankruptcy would be cheaper if you started it now. But in that case, you're probably going to need family help or some other resources to be getting through the bankruptcy. And I'm with you. I just don't think it's the right thing option. That scares me the most is that you're feeling stressed about not making your payments, and so you make the horrible, horrible mistake of a payday loan or an installment loan because they're easy to get. The hours are quite accessible. I mean, you can do it in the middle of the night in your underwear, and it's just, it'll solve the immediate problem, and it'll create one that's so much worse. Well, and I did have that discussion with someone yesterday too, whose debt has increased during this period for those exact reasons, which is obviously counterproductive in the long run. Right. Okay, so that's one scenario. I've got very low income. It's all essentially not wages, so it can't be garnished under the Wages Act. Right. So I end up waiting, is what you're saying. The other scenario would be, okay, I do have money coming in. Right. So let's say I've got 3 or 4 different debts and I do have enough money to be servicing them to some extent. How do I decide which dollar goes to which guy? All right. So from a financial standpoint, the practical thing to do is try to service the most expensive debts first. So if you can get a deferral on a mortgage and you've got a bunch of credit card debt and you didn't really need to defer the mortgage, maybe you should for a couple of months to pay down the credit card debt. The extra interest you'll pay on the mortgage is nowhere near what you'll save in paying off the credit cards. Yeah, and so the people who have deferred mortgage payments and used that savings to pay down higher interest debt, good strategy. Can't really argue with that. That actually makes sense. I'm going to end up with 3% more in interest to pay on my mortgage, but I ended up saving 20% on my credit card or more. Right. And I guess in some cases you could make lump sum payments to people too then. Yep, if you've got the ability. Same theory. Yep, and again, so keep in mind you may have a lump sum, you may have these extra payments we were talking about with the car loans. They're not doing that with the mortgages, but make sure you've got enough set aside, the deferral ends, you can deal with them. But yes, throwing money at the highest, most expensive debt makes sense. And so the deferral periods are over, but is there any reason why you can't talk to your lender and say, hey, look, I realize the deferral period's over, but can you give me a bit of a break? Can you help me with the interest? Can you tack it on to the end? Is there any reason not to do that? And there's no reason not to try that. In fact, put the pandemic aside. We discuss with people, look, can you just talk to your bank and see if there's some way that they will help you? The banks don't want to lose your business. They don't want to lose the interest. They don't want you filing bankruptcy or a proposal. So talking to the bank before you make a decision is a good one.
Well, and if I'm a big bank, I have to report my quarterly results every quarter. I'm guessing. And I don't want to be showing a massive increase in my loan loss provision.
Correct.
Because that means my profit is therefore lower, and that's going to hurt my stock price, and nobody's going to like me. So if I can make a deal with you to defer.
Yeah. Well, if you understand how banking statistics work, if they were to actually approve you for a new loan to pay out the old loan, their stats look so much better because we paid off an old one and we've written new paper.
And so it would not shock me at all if there was some refinancing going on, but also if they said, okay, we'll give you an extra couple of months, pay $10 a month and that's it. Right. Well, so now it's still a performing loan. Don't have to set it up under loan loss provisions. My profit still looks good. That's kicking the can down the road. The debtors are doing it with the deferrals, but the banks may be doing it through refinancing and whatnot. Right. So our advice is, well, sure. I mean, you can pick up the phone and talk to them. Yep. Now, of course, they may go, oh boy, you're still not back to work. We're going to, put a cap on your line of credit. We're going to do some other things. Right. So this could backfire. But if you're in a position where you can't pay anyways, well, and what's the downside? So
the one caveat to renegotiating is make sure you don't agree to something that you can't do. Or said a more positive way, make sure whatever you agree to, you are able to do. There's no point getting a reduced payment if you still can't make the reduced payment. Yep. Right? Be honest with yourself. Be honest with the bank.
Don't make a promise you can't keep. So agreeing to pay $500 next month when you're not going to have it doesn't serve any purpose at all.
In fact, it probably makes things worse.
Yeah, because now they're not willing to make any kind of arrangements with you.
Yep.
Okay, so let's get into the more serious situation now. I'm not going to be able to get caught up on my car loan. Right. Maybe I'm working from home now, so I don't really need the car anyways. At what point do I decide or consider just walking away from the car loan? What are the implications of that?
It's going to be different for every person, but effectively, your rent is your most expensive item every month. Your car is probably your second most expensive one. If you can make the determination that you don't need that car anymore, that's a huge financial implications. It's cash that's going to be in your pocket. Now, there are consequences. You're going to say, look, I want to voluntarily return this car. The bank's going to take it back. They're going to sell it at auction, and then they're going to send you a letter saying you still owe us this much money.
$10,000.
Whatever that number is. And they're going to ask you to make payment terms on it. So we now might be talking about a second solution after you do the first one. But the important consideration is, can I afford the mortgage? Can I afford the car payment? Should I proactively make these decisions to make changes before they're imposed on me? It's better for you to decide to give the car back than it is for you to go out one morning and find out the car isn't there.
And there's a big difference between a car and a house.
Houses don't move very much.
You can't drive them. The big difference is, of course, that over the last 10 years, house prices have gone up. Right. And so the car I bought 5 years ago is probably worth less than when I bought it.
Your particular car, yes.
I don't know. It wasn't worth much 5 years ago. Well, it's a 2011, so it's been around for a while. But yeah, the house has probably gone up in value. So I'm sitting there going, you know what? There's no way I can keep making the mortgage payments and property taxes and everything else. But if I sell my house, I can actually pay off the mortgage, maybe even put a bunch of cash in my pocket and rent. So that makes perfect sense to me. Right. Because now I've reduced my cash flow and okay, nobody likes to rent, but rental costs certainly in downtown Toronto are coming down. Maybe in the outlying areas, not so much. The car is a different one because, okay, there's going to be a shortfall. And you and I have been doing this for 30 years. So pretty much every time someone surrenders a car, the shortfall is always $10,000.
There's going to be a bill.
It doesn't matter how long you've had that. I mean, it's always ends up being $10,000. That's just the way it is. Because of course, when they sell it at auction, they're getting less than what it's really worth. Right. So if I decide I can't afford to keep the car and maybe I don't even need it, I surrender it. Yep. I get hit with this $10,000 bill. Well, choice number one is I guess I got to make payment arrangements with the bank. And if that's my only debt, maybe I can do it. Maybe. But if I have a bunch of other debts, okay, now what's the decision?
So now maybe we're looking at a consumer proposal or even a bankruptcy. I mean, once you get to the point where you've made these major life choices, do I sell the house? Do I return the car? And you still have debt issues, well, you've got to get some professional advice. And our advice might be to just live with it for a couple months still. I mean, that's still the most common thing I'm saying to people. But at least you've got information. You're talking to people and you have a plan in place. You're not going to be happy about thinking about a consumer proposal, but having a plan will make you feel better because you're back in control.
And that's really the key to it. And we've dealt with, I know you and I both have, people that we first talked to early in the year. Right. They were getting ready to file a proposal or a bankruptcy because they had a bunch of debt. Then the lockdown hit and it's like, well, I'm not working now, so the pressure is off. And a lot of those people are now coming back saying, okay, I'm now partially back to work.
Yep.
I now want to deal with it. So in their case, waiting was the correct option because they're in a better position now to know what the correct solution is. I don't like pushing someone into a bankruptcy only to find out that their income is going to be a lot higher and it's going to be very costly.
Right.
I also don't like pushing someone into a proposal that they can't afford.
Right.
I'm a big believer in check the weather forecast. Is it going to rain? Okay, I'll bring an umbrella. It isn't, I won't.
Yep.
I don't carry an umbrella with me everywhere I go all the time.
It's because you're not English.
No, I'd look good with one though, probably. I, of course, do wear my Bonnie chapeau, but it's make the decision when you need to, but have all the facts so that you can then decide, okay, if this happens, I'm going to do this. If this happens,
You're making an informed decision. And again, you may not be happy about it, but you will be in control, so you will feel better about yourself.
So final words of advice then are analyze your situation, and if you're uncertain about whether you can pay that debt, then reach out for help.
That's right. If a problem seems too big for you to get your head around it, break it into little pieces. And that's what we specialize in doing, helping people look at the problem from a different perspective and making it manageable.
And one of the advantages of what we're going through now is it used to be you came into our office, we sat with you for 45 minutes, 30 minutes, debt-free in 30, that's where that comes from, however long it took to go through things. What we're finding now is maybe we'll spend 10 or 15 minutes on the phone with you and kind of sketch out what the different options are. And you say, okay, I've got a job interview next week. Great. Let's talk after that.
Right.
And if you get the job, we'll do this. If you don't, we'll do that. So we can have many individual chats with you because it's really easy. We pick up the phone, we do it over Zoom, and it's
that's
easy.
certainly what we're doing now. It used to be somebody would come in, we'd make the decision and get it done. Now we are, for lack of a better term, nurturing people. We're helping them through this period of transition.
And we hopefully end up coming up with the right solution.
Right.
Excellent. So there you go. Deferrals are going to be a big issue, certainly in October, and I think going forward. So the sooner you get a handle on what's going on, the sooner you can come up with a solution for it. Ted, thanks very much for being here. That is our show for today. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.